Disclaimer.
Picture this. It's 2:47 in the morning on December 28th, 2025. Most Americans are sound asleep, but somewhere in a Manhattan trading floor, emergency lights are flashing. A major financial institution just failed a margin call on their silver positions. The metal had spiked to $84 an ounce overnight, and someone didn't have enough cash to cover their bets. Within hours, CME Group, the organization that runs America's commodity exchanges, issued their second emergency margin hike in 2 weeks. They raised the cost to hold a single silver contract to $25,000, up from $20,000. This wasn't about managing normal market volatility. This was about preventing a cascade of failures as the paper silver market started cracking under the weight of something much bigger. What happened at 2:47 a.m. wasn't random chaos. It was the sound of a market breaking, the moment when decades of paper price games collided with physical reality. Now, here's where this gets interesting. And while that margin call drama was unfolding in New York, halfway around the world in Beijing, a clock was ticking down to midnight. When January 1st arrived in China, something changed in the global silver market that most people still don't understand. The Chinese Ministry of Commerce had announced new export licensing requirements back on October 30th. The rules seemed technical and boring, the kind of policy change that gets buried on page 17 of the Financial Times. But those requirements were surgical in their precision. Any company wanting to export silver from China now needs to prove they can produce at least 80 tons annually. They also have to demonstrate they've been continuously exporting from 2022 through 2024. Sounds reasonable, right? Except here's what that actually means. Hundreds of small and mid-sized Chinese refiners, companies that have been quietly supplying the world with refined silver for decades, were instantly disqualified. Let me put this in perspective for you. China doesn't just participate in the silver market. According to industry data and trade flow analysis, Chinese refiners control somewhere between 60 and 70% of the world's refined silver supply. Not market share in the sense of they're big players. We're talking about genuine single point of failure dependency. When one country controls more than half of a critical industrial metal and implements overnight licensing restrictions, you're not watching protectionism. You're watching weaponization. Pop quiz. What do solar panels, semiconductors, electric vehicles, and AI data centers all have in common? They all require silver, and not in small amounts. A single solar panel needs 10 to 20 grams of silver. There's no substitute that matches its conductivity and reliability in these applications. Your smartphone's circuitry, the 5G towers transmitting this video to your device, the electric vehicle battery systems, the thermal management keeping data centers from overheating. Silver is woven into the infrastructure of modern technology. According to the Silver Institute and Metals Focus research, global industrial demand hit 1.24 billion ounces in 2025. Total supply from mining and recycling, only 1.01 billion ounces. That's a shortfall of 230 million ounces in a single year. And here's the kicker. This marks the 6th consecutive year of structural supply deficits. The world has been consuming more silver than it produces for over half a decade, and that gap is widening. Think about what that means. For 6 straight years, we've been drawing down existing stockpiles to meet demand. But those stockpiles aren't infinite. They're not even close to sufficient anymore. The evidence for this crisis is hiding in plain sight if you know where to look. COMEX, the New York exchange where silver futures trade, maintains 2 categories of silver inventory. Registered, metal available for immediate delivery, and eligible metal that could be registered. The registered inventory is what actually matters when contract holders demand physical silver instead of rolling their positions forward. Since 2020, COMEX registered silver inventories have collapsed by 70%. But December 2025 revealed something that should make every investor pay attention. In just 4 trading days, market participants claimed 47.6 million ounces for physical delivery. That represents 60% of the entire registered inventory, gone in less than a week. When traders who normally traffic in paper contracts suddenly demand the actual metal in massive quantities, that's not typical market behavior. That's panic. That's people who understand that the game is changing and paper promises might not be worth what they used to be. This surge in delivery demands triggered something technical analysts call backwardation. In normal commodity markets, futures contracts trade at higher prices than spot prices because of storage costs and the time value of money. It's called contango, and it's how these markets typically function. But silver flipped into backwardation in late 2025, spot prices trading above futures prices. The market is literally screaming, we need physical metal right now, not promises for delivery 6 months from now. Want to know how desperate the physical demand has become? Look at Shanghai. While COMEX futures were trading around $70 per ounce, physical silver in Shanghai was commanding $77 to $80, a premium of $7 to $8 per ounce. In commodity markets, price spreads like that don't persist unless there's genuine scarcity in one location. Chinese buyers are paying massive premiums because they can see what's coming. After January 1st, that metal becomes trapped behind China's new export licensing walls. This isn't theoretical. This is happening right now. American manufacturers, who depend on silver for solar panels, electronics, and industrial applications, are watching their primary supply source systematically choked off. The overnight margin call at 2:47 a.m. was just one institution's crisis, but the clock striking midnight on January 1st in Beijing, that was the moment a global supply chain got cut at its single most critical junction. Here's what should grab our attention. Silver isn't gold. Gold mostly sits in vaults as a store of value. Central banks hold it. Investors collect it. But the vast majority of silver gets consumed and destroyed in industrial processes. You can't recycle the silver that's been deposited in microlayers on semiconductor wafers. The silver paste used in solar panels is permanently embedded. The tiny quantities used in every electronic device are economically impossible to recover. This means the supply-demand equation for silver operates under completely different rules than gold. When you have exponentially growing industrial demand colliding with contracting supply and vanishing stockpiles, the math gets brutal fast. Prices have to rise until demand destruction occurs, until it becomes so expensive that some users simply can't afford to buy anymore. But here's the problem with that theory in 2026. Most of the industrial demand for silver is price inelastic. You cannot build solar panels without silver, and governments around the world have mandated massive solar deployment targets. You cannot manufacture semiconductors without silver conductivity. You cannot achieve the electric vehicle penetration rates that every major automaker has committed to without silver in battery management systems. The demand isn't optional. It's baked into trillion-dollar infrastructure commitments, climate policy mandates, and technological transition plans that took decades to build political consensus around. These industrial users can't just stop buying silver because the price doubled. They have to keep buying until their entire business model becomes unviable. So we're left with this situation. China controls 60 to 70% of global refined supply and just implemented export restrictions. Industrial demand exceeds supply by 230 million ounces annually with no signs of slowing. COMEX inventories are being drained at unprecedented rates. Physical premiums in Asia are surging. And a major financial institution just failed a margin call at 2:47 in the morning because silver spiked to $84 an ounce. That's not a normal market correction. That's the early tremors before something breaks completely. The question we need to ask ourselves isn't whether this supply crisis is real. The evidence is overwhelming. The question is, what happens next when the world's factories, solar companies, tech manufacturers, and defense contractors all realize they're competing for a metal that's increasingly trapped behind Chinese export controls while existing stockpiles approach zero? Because once that realization spreads beyond the overnight traders who got that 2:47 a.m. margin call, the psychology of this market changes completely. And markets that trade on psychology rather than fundamentals, those are the markets where price moves from $70 to numbers that seem impossible, right up until they are not impossible anymore. Now let me show you why institutional investors are repositioning billions of dollars based on what's happening in the silver market. Because the evidence we're about to examine doesn't come from conspiracy theorists or newsletter promoters. It comes from regulatory filings, exchange data, and the actions of the world's most sophisticated financial institutions. Let's start with J.P. Morgan Chase, the largest bank in America and one of the most powerful financial institutions on the planet. For over a decade, J.P. Morgan maintained a massive short position in paper silver contracts on COMEX. We're talking about roughly 200 million ounces of naked shorts. Critics called it price manipulation. Regulators actually fined the bank nearly $1 billion for spoofing precious metals markets. But the position persisted year after year, keeping a lid on silver prices even as industrial demand kept climbing. Then something changed. Between June and October of 2025, J.P. Morgan did something that veteran precious metals traders thought they'd never see. The bank completely unwound its entire short position. Every last contract, gone. But here's where it gets absolutely wild. They didn't just exit their shorts. They flipped to the other side completely. Current estimates based on warehouse receipts, ETF custodial data, and market positioning suggest J.P. Morgan now holds somewhere around 750 million ounces of physical silver. Let me put that number in context for you. That's nearly equivalent to one full year of global mine production sitting in J.P. Morgan as vaults. According to COMEX data and industry analysis, the bank now controls approximately 40% of silver futures contracts, while simultaneously holding this enormous physical inventory. This isn't a hedge. This isn't portfolio diversification. This is a complete strategic repositioning that required deploying over $50 billion at current prices. Banks like JP Morgan don't make $50 billion bets unless they see something in the market structure that regular investors can't see yet. So how did they actually pull this off? Multiple sources in the precious metals community indicate that JP Morgan essentially cut their silver lease agreements with other major banks, institutions like HSBC, UBS, and Deutsche Bank. These banks had borrowed silver from JP Morgan and were paying lease rates to maintain those positions. When JP Morgan called those leases, it forced these institutions to go into the market and buy back the borrowed silver at whatever price necessary. Those forced buybacks created losses for the other banks, but injected billions back into JP Morgan's capital, which was then redeployed into physical accumulation. The speed of this accumulation tells you everything about their urgency. In just 6 weeks during late 2025, JP Morgan added 21 million ounces to their holdings. That's not patient, long-term value investing. That's aggressive positioning ahead of an event they see coming. And then there's the Singapore move. Market intelligence suggests JP Morgan is in the process of relocating its precious metals trading desk from New York to Singapore. Think about the strategic implications here. They're positioning for Asia's industrial demand explosion while simultaneously distancing their operations from U.S. regulatory oversight. When the world's largest silver shorter becomes the world's largest silver holder and moves operations to Asia precisely as China locks down exports, you're not watching coincidence, you're watching preparation. Here's what makes this moment so eerie for anyone who knows market history. We've seen this pattern before. In 1979 and 1980, Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, attempted to corner the silver market. They accumulated physical silver in futures contracts, driving prices from $6 an ounce all the way to $50. The market went parabolic. Then regulators intervened with emergency margin requirement increases, forcing liquidation. The Hunt brothers' empire collapsed and silver crashed back down. The pattern rhymes with what we're seeing in 2025 and 2026, but with critical differences. Back then, it was private individuals trying to corner the market for speculative profit. Regulators stepped in with CME margin hikes, forced liquidation, and the scheme fell apart. Today, we're watching JP Morgan, a systemically important financial institution, accumulate physical silver. And yes, CME Group issued advisory 25393 raising margin requirements to $25,000 per contract amid market backwardation, exactly like the regulatory interventions that preceded the 1980 collapse. But here's the crucial difference. In 1980, industrial demand for silver was modest. Most silver use was in photography and minor industrial applications. Supply was expanding from new mines. Today, industrial demand is exponential and essential. Solar panel production alone now consumes over 200 million ounces annually, and that number is projected to keep climbing. Electric vehicles, 5G infrastructure, AI data centers, these aren't optional discretionary uses. These are the foundations of every major economy's technology transition plans. And supply? Instead of expanding like it was in 1980, supply is now contracting via Chinese export controls. The Hunt brothers were fighting against expanding supply and modest demand. JP Morgan is positioning for contracting supply and explosive demand. Completely different setup. Want to know how seriously industrial users are taking the supply threat? On December 26, 2025, Elon Musk tweeted in response to China's export restriction announcement. His exact words, "This is not good. Silver is needed in many industrial processes." That single tweet triggered a 9% single-day price surge, pushing silver to a record of $78.53 per ounce. Now, Elon Musk comments on a lot of things, but when he publicly warns about commodity supply constraints, you need to understand the context. Tesla, SpaceX, and Starlink are among the world's largest industrial consumers of silver. Tesla's electric vehicles use silver in battery management, power electronics, and charging systems. SpaceX satellites require silver for solar panels and circuitry. Starlink's ground stations and terminals use silver in their electronics. This isn't Musk speculating about a metal he read about in a newsletter. This is a supply chain panic from someone whose entire business empire depends on securing this metal. The market response to his comment tells you everything. 9% in a single day on a $70 billion market does not happen because traders thought Musk made a clever observation. It happened because every industrial buyer who saw that tweet immediately realized their competitors are waking up to the same supply crisis. And the race to secure physical metal is accelerating. Let me show you another piece of evidence that should concern anyone paying attention: backwardation. I mentioned this earlier, but let's go deeper on what it actually means. In normal commodity markets, futures contracts trade at prices higher than spot prices. This structure, called contango, reflects storage costs, insurance, and the time value of money. It's the natural state of most commodity markets most of the time. Silver has been in backwardation since late 2025. Spot prices are trading above futures prices. This is the market's way of screaming, We desperately need physical metal right now. We do not trust promises for future delivery. We will pay a premium to get the actual metal today instead of a contract promising delivery in 6 months. When you combine backwardation with COMEX vault depletion and rising margin requirements, you're looking at a situation where the exchange itself may struggle to deliver physical metal against outstanding contracts. And when an exchange can't deliver, you get what's called a delivery failure or force majeure declaration. At that point, price discovery moves away from the paper futures market and shifts to physical markets in places like Shanghai and Zurich, where actual metal changes hands. Now let's talk about the ETF situation, because this is where JP Morgan's positioning gets truly unprecedented. The iShares Silver Trust, ticker symbol SLV, is the largest silver ETF in the world, holding hundreds of millions of ounces backing its shares. Guess who the custodian for SLV is? JP Morgan. The same bank that spent a decade shorting paper silver now physically holds the metal backing the world's largest silver ETF. They're also controlling 40% of COMEX futures positions. Let me spell out what this means. No single entity has ever controlled more than 10 to 15% of any major commodity futures market in modern history. The concentration of control we're seeing with JP Morgan in silver is historically unprecedented. They're the custodian for the largest ETF. They hold the largest physical inventory. They control the largest futures position, and they just moved their trading desk to Singapore. This isn't market participation. This is market domination. And the fact that they achieved this position precisely as China implemented export restrictions and COMEX inventories collapsed to multi-decade lows tells you they saw exactly what was coming. Here's the question that should keep you up at night. What does JP Morgan know about the coming supply situation that would justify risking $50+ billion on a single commodity play? Because banks don't make bets this large on hunches. They make bets this large when the math is so overwhelmingly in their favor that the risk-adjusted return is almost guaranteed. The evidence suggests they know the same thing industrial buyers are figuring out right now. The physical metal is running out. China locked down 60 to 70% of global supply. COMEX vaults are being drained. Shanghai inventories are down 86% from their 2020 peak. London Metal Exchange warehouses are down 40%. And industrial demand is accelerating into these vanishing stockpiles. When the world's smartest financial minds are positioning for a supply crisis of this magnitude, and when the world's largest industrial users are publicly warning about supply constraints, maybe we should be paying attention to what comes next. Because if JP Morgan is right about where this market is headed, the $70 silver we're seeing today is going to look quaint compared to what happens when physical delivery failures force true price discovery. Let's do the math that Wall Street doesn't want us calculating. Because when you actually run the numbers on this supply-demand situation, the conclusions become unavoidable. Start with the structural deficit. According to the Silver Institute and Metals Focus Comprehensive Research, 2025 saw global silver demand reach 1.24 billion ounces. Total supply from mining and recycling, 1.01 billion ounces. That's an annual shortfall of 230 million ounces. And this marks the 6th consecutive year we've been running a deficit. The world is consuming more silver than it's producing year after year, and that gap is actually widening. Now here's where it gets critical. This isn't a temporary imbalance that corrects itself. Solar panel production is accelerating globally, projected to consume more than 200 million ounces annually by the end of 2026. Electric vehicle penetration is increasing the silver content per vehicle as battery management systems get more sophisticated. AI infrastructure demands massive thermal management solutions, which means silver paste in semiconductors and chips. And semiconductor manufacturing has no viable substitutes for silver's unique conductivity properties. The demand isn't discretionary. You cannot shut down these industrial processes because silver got expensive. The industrial users are locked into trillion-dollar technology transitions that took decades of planning, political consensus building, and infrastructure investment. They have to keep buying silver until the price becomes so prohibitive that their entire business model collapses. Now layer in the China export impact. If China's new licensing restrictions reduce available global supply by even 30%, and that's a conservative estimate given they control 60 to 70% of refined supply, and the restrictions exclude 70% of current exporters, that removes another 300 million ounces from international markets. Combined with the existing 230 million ounce annual deficit, we're potentially looking at a 500 million ounce supply gap in 2026. Think about what happens when annual demand exceeds supply by 40 to 50% with no quick substitutes and major institutions stockpiling physical metal. Price has to rise until demand destruction occurs. But here's the problem. Most industrial silver use is price inelastic up to very high levels. You cannot build solar panels without silver. Semiconductors require it for conductivity. The demand continues even as prices climb because the alternative, stopping production entirely, is worse than paying higher input costs. So how high could silver actually go? Let's look at multiple analytical frameworks to understand the range of possibilities. First, the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Currently, it's trading around 65 to 1, meaning 65 ounces of silver equals 1 ounce of gold. With gold at $4,562 per ounce right now, that puts silver at about $70. But here's the historical context. During periods when global silver stockpiles were abundant and industrial demand was modest, the ratio averaged 30 to 35 to 1. We're nowhere near that historical norm. And critically, we're no longer in a world of abundant stockpiles. The U.S. strategic silver reserve has been depleted. China's domestic inventories are at decade lows, just 715 tons in Shanghai, down 86% from the 2020 peak of over 5,000 tons. London's LBMA vaults are down 40%. So what happens if the ratio starts moving back toward historical norms in a world where stockpiles have vanished? If the gold-silver ratio reaches 50 to 1 with gold at current prices, silver hits $91 per ounce. If it reaches the historical 35 to 1 level, silver reaches $130. And if it overshoots to 30 to 1, which is entirely possible, given we now have zero stockpiles versus the historical periods of abundance, silver hits $152 per ounce. Now let's look at technical analysis. Chart analysts have noted that silver's multi-decade price consolidation formed what's called a cup and handle pattern. This is a bullish formation where a long period of base building creates enormous energy for the eventual breakout. Silver's cup and handle pattern spans more than 40 years of consolidation, with the breakout occurring at $30 per ounce in early 2025. Historical cup and handle patterns of this scale and duration have produced gains of 700% or more from the breakout point. Applied to silver's $30 breakout level, that implies a target of $240 per ounce. Even conservative variations of this projection suggest $120 to $180 as plausible targets. What about institutional forecasts? Let's look at what the major banks and research firms are actually telling their clients. JP Morgan published research projecting gold will reach $5,055 by the fourth quarter of 2026. They haven't published specific silver targets publicly, but their physical positioning suggests they're expecting silver well above $100. Bank of America, UBS, and Metals Focus have established consensus baseline forecasts of $55 to $65 average for 2026, with explicit upside potential to $70 to $100 plus if investment flows accelerate beyond current levels. Independent analysts like Mike Maloney and research teams at precious metals dealers are projecting triple-digit silver $100 plus as a near-term target with potential for $250 to $300 if physical scarcity forces price discovery away from the paper futures markets entirely. Multiple technical analysts are pointing to $85 to $90 as short-term targets based on ascending broadening wedge patterns visible on the charts. Now let's talk about the critical window we're in right now. Silver faces two distinct scenarios in January and February of 2026. Scenario A is consolidation. After 150% gains in 2025, profit-taking, combined with year-end portfolio rebalancing, and the pain from higher margin requirements, could cause a pullback to the $52 to $56 range. That's roughly where the 10-week moving average support sits. This would create one final accumulation opportunity before the next major leg higher, potentially in the second quarter of 2026, as the full impact of Chinese export restrictions becomes undeniable. Scenario B is squeeze acceleration. In this path, physical delivery demands overwhelm COMEX's capacity to source metal. The exchange implements emergency position limits or declares force majeure on delivery obligations. At that point, price discovery shifts entirely to physical markets in Shanghai, Zurich, and other locations where actual metal still trades hands. You'd see a gap-up move toward $100 or higher as the paper markets lose their pricing authority entirely. Which scenario plays out depends on a few specific catalysts we can track. On January 6th, CoinCodex's algorithm predicts a minor consolidation to around $70.79. January 27th brings the Kerr Mining shareholder vote on their acquisition of New Gold. If approved, this creates a $20 billion market cap silver producer with $2 billion in annual free cash flow, a major new force in the physical market. The first quarter of 2026 will be the first full quarter operating under Chinese export restrictions, revealing the true supply impact. And the fourth quarter of 2026 is JP Morgan's timeline for their 50.055 gold target, which implies proportional silver targets anywhere from $85 to $130 depending on ratio compression. Here's what this means for regular Americans thinking about their financial future. This isn't about trying to trade silver futures for quick 10% gains. This is about understanding that 6 consecutive years of supply deficits have now collided with the world's largest supplier implementing export controls, while the world's most sophisticated bank just became the dominant holder. JP Morgan didn't flip $50 billion plus of positioning based on a hunch or speculative trade. China didn't weaponize 60% of global refined supply just for diplomatic negotiating leverage. Elon Musk didn't publicly warn about industrial supply constraints because he enjoys commodity market drama. These are calculated moves by entities with access to supply chain data and market intelligence that we don't see. The physical metal is vanishing from every major storage location. COMEX registered vaults are down 70% from 2020 levels. Shanghai inventories have collapsed 86%. London's LBMA warehouses are down 40%. When inventories approach zero while demand grows exponentially, price becomes the only mechanism left to ration scarce supply among competing buyers. The real question isn't whether silver reaches $100 per ounce. The institutional positioning, the supply-demand mathematics, and the geopolitical supply lockdowns all point in that direction. The question that should concern us is, when physical delivery failures force true price discovery away from the paper futures markets, will it stop at $100? Or will silver behave like a broken dam, where the price that was held artificially low for decades suddenly seeks its true equilibrium in a world of genuine scarcity? Because here's the uncomfortable truth. Every major financial crisis follows the same pattern. The warning signs are visible for months or years in advance. The data is hiding in plain sight. Institutional players reposition their capital ahead of the crowd. But regular investors don't pay attention until the crisis is already underway and the opportunity to prepare has passed. We're watching that pattern unfold right now in the silver market. The 2:47 a.m. margin call in late December was a warning shot. The January 1st export restrictions were the starting gun. JP Morgan's $50 billion flip from short to long is the institutional confirmation, and the backwardation, vault depletion, and Shanghai premiums are the market screaming that the old price discovery mechanism is breaking down. The choice we face is simple. Do we pay attention to what the evidence is showing us, or do we wait until the price has already moved and then wonder why we didn't see it coming? Because unlike the people who got blindsided at 2:47 in the morning on December 28th, we have the advantage of knowing what's happening while there's still time to understand it. The math doesn't lie. The supply is vanishing, the demand is accelerating, and the institutions that control our financial system are positioning for something they see coming that hasn't reached mainstream awareness yet. Maybe it is time we started paying attention to what they're doing instead of what they're saying.